Hey everyone, welcome back to another episode of Stage Debate with Isaac. Today we have some awesome guys and friends on. Israel Leiner with Walker and Dunlap, Jake Gluck with Fortune Capital Group, and Rickey Shneyder with Crux Commercial Partners. All tremendous guys in the debt brokerage space. Have all done amazing deals, know how to structure deals. I'm excited for the conversation. It's gonna be a good one. Today's episode sponsor is Epic Signs. Epic Signs is truly epic. They've worked in almost all 50 states for all your signage needs. So whether you have a multifamily property, a hotel, a strip center, whatever it may be, a mobile home park that needs signage, whether it's in the front, whether it's on the actual buildings, these are your guys. Service at its best, great pricing, competitive pricing. These guys are the one-stop shop for all your signage needs. Thank you guys for the sponsorship. Sam Berkowitz, he's a guy you can get in touch with on LinkedIn. He's a LinkedIn mogul, as they call it, and a good friend of mine. Thank you to our corporate sponsor, as usual, Michael Stern of Line Star Tax and LST Consultants. You've been a tremendous partner and friend. These guys not only are tax geniuses, but they're also leasing specialists, collection specialists. They really know the space really, really well. You want to get your property leased up. You want to get your property, the money that's owed. You want to get that money in. These are the guys to contact. Tune in, guys. I'm excited. Let's go. Hey, everyone. Welcome back to another episode of Stage Debate with Isaac. I'm your host, Isaac Weinberger. We have some fabulous guests on today. We got Jake Gluck from Fortune Capital Group, and I have to say, no tease to anybody else here, but I love the name. There's just something about it. I just think it's a cool name. I feel like I win the lottery, like Fortune Capital Group. It's a cool name. We got Israel Leiner, a good friend of mine from Walker and Dunlap, and we got Rickey Shneyder, just what a man, with Crux Commercial Partners. Did I say that right, Rickey?
You did.
Crux Commercial Partners. Rickey has really locked down a lot of the Midwest. All these folks over here, just to the audience, all these folks here are devoted debt brokers. A lot of folks don't like the terminology debt brokers, but really devoted service providers that will partner up with you on your deal and do it right. And really come with some great terms and help you close that deal. So thank you guys so much for coming on. We'll start with Israel. Israel, can you introduce yourself? Tell us a little bit about yourself, how you got to the space, what you're working on, and I guess your niche, what you bring to the table.
Israel Leiner with Walker and Dunlop, based out in Englewood Cliffs, New Jersey. Been in capital market, debt brokerage for about 8 years now. What brought me into the business is really number one, real estate. Always loved real estate. I feel like it's one of the few investment vehicles that you can actually touch and feel. You could drive down to the asset. You can go look at it. You can go really get a good understanding of where you're putting your money in. So real estate was always something that was very attractive to me at a young age. And number two, servicing. I always love servicing people, solving people's issues. And one thing you understand when you start speaking to people on a day-to-day basis that it's always a lot greater than the terms you put forward. It's getting the deal done from beginning to end. And that can mean a lot of different things. That can mean, working through some issues with an investor that the borrower has, working through a property related issue when the property condition report, something comes up when we're not expecting it. But it's really just putting the pieces together, making sure you close at when it needs to close at the terms presented up front and kind of that all the pieces of the puzzle is something I always enjoyed doing. I think it comes together being a mortgage broker slash capital markets debt originator.
I love something that you said, just this idea of bringing the deal to the close, and no matter what it takes. And I've dealt with folks. We have mutual clients, and I send you a text, an email. Like before I could finish the email, you already responded. I'm like, oh my god! Like I thought I was good.
Yep, it's like I'm one up on you.
That's it's pretty impressive, and you're definitely devoted, Rickey. We've been friends for a while. I appreciate you a lot. You've done a lot of good things in the space, and I think that one of your biggest, I guess, attributes is your honesty. Extremely honest man. And when it comes to the debt space, it can get confusing sometimes. It's easy to be dishonest, and you really held to that. You're a good man, and we've done a lot of business together. Tell us a little more how you got to the space and give us a background.
Sure. First of all, thank you as well for having me on. Really appreciate being part of this great panel and anything to support you, Isaac. You're great guy and do great things in this space. Best networker of all time, as we all like to say. Rickey Shneyder from Crux Commercial Partners, one of the partners here. We're a national debt brokerage firm. I spent about 21 years in commercial banking, working for two major national banks. Half the time in commercial real estate, half the time within operating companies, what we call C&I lending. What drove me to operate within Crux and brokerage and now in joining my now business partners was I like the fact that we can shop all solutions, that we don't have to operate under one platform. So if a customer or prospective customer calls and says, I have this need, we can look at all different variations to make sure we could put the best possible solution in front of them. Our firm is a little unique in that we don't have a box as well. We technically don't have a minimum or maximum and work nationally. And sometimes we'll come across scenarios where we need a partner. Like Israel and I have been working on two credits together. I know earlier we talked about the panel being competitors. Candidly, I look at them as partners. And when we put our egos aside to the prospective borrower and say, hey, I'm going to call in somebody that's equally good, I think that makes for a very powerful presentation. And that's one of the things I also love about brokerage.
I love it. And I agree with you. Sometimes folks look at everything as competition. If we could work together on stuff. And I've had competitors reach out to me, hey, we can't handle this project right now. It's actually just happened recently. And I have to learn from that. I have to learn. I don't run away from competitors at events. I talk to them. We share advice. We share tidbits. I love that. Jake from Fortune Capital Group. I mean this when I say it. I'm in the flattery business. I'm not in the real estate world. I'm a sales guy. I'm in the flattery industry. But I mean it when I say it. You're from the smartest guys that I've spoken to. I respect you as a person, as a friend. You've done a lot of great stuff in the space, closing deals left and right these days. How'd you get here? What's your background and what's your niche?
First of all, thank you. I appreciate that. I'm really honored to be. I know Israel. I just met Rickey, but honored to be on this with you guys. I started out, honestly, I just fell into it. I was doing some weird job right when I came out of school with credit card negotiations, and I hated it. And a friend of mine was like, I'm in commercial mortgages. All these guys, they're looking for somebody to run the mortgage banking division for the company that I work at. Do you want to come? And I was like, I don't know what that means, but sure. I spent the next 2 years sitting with senior lending officers at M&T Bank. There was a big bank, People's United Bank, we were doing a lot of business with, Customers Bank. Really just learning everything about the industry. I had the amazing opportunity to basically have an executive level position the first day that I walked into the job. Iris Lodowitz gave me that opportunity, and I appreciate that. Over the next probably 7 to 9 years, I worked at Eastern Union for a little bit. I partnered up with somebody else. In 2019, I opened up Fortune Capital Group. Fortune is actually the English version of my last name, which is Gluck. Gluck is good luck. And so it translated. And I definitely needed it because opening right before COVID was probably the biggest challenge that you can have. We all went through COVID. A lot of people were very successful in COVID because they had a lot of agency business. They had a lot of clients that were doing bridge loans. I really basically started over during COVID, so doing a lot of smaller stuff. But because I had to start from scratch, I found a niche. Anytime I had an opportunity to work on something complex, I took it on. We did a lot of construction stuff. We did a lot of very complicated refinances for different people. We weren't scared to take on commercial deals. And what I'm finding is that over the past 2 years is that there's obviously definitely a lot of value to the guys that know the agency business. And, I'm sure Israel can speak to that tremendously. It's at Walker. But we've found a ton of success on a lot of special use stuff. We've been doing a lot of CMBS business this year. Tremendous amount of CMBS business, a lot of construction stuff, obviously the bread and butter agency stuff, but we've really been able to find our footing in this particular market, and we're actually pretty excited about it, which I know is kind of funny, but I'm grateful for it too.
I like it. I like it. Wow. It's always good to hear where the names come from. Every time I meet with somebody, it's something I'm just intrigued about. Like, where'd you get the company name from? Like, I don't know, whatever equities, where'd it come from? And there's always a story. I don't say always, a lot of times there's a story to it. Interesting. I like it. So Jake, once we're with you, let's dive straight in. Might sound cliche, but for a lot of folks out there, I think it's important to hear this. So we've had a lot of people over the past couple of years that the bridge loans, and those loans are expiring, obviously, and they were over leveraged. My question is just in general, what's your take on over leverage, under leverage? I folks come to me all the time, and again, I'm not a debt broker, but they come to me all the time, and they say, hey, how much depreciation is this guy going to get back per dollar invested? So the first question I always ask, what's the LTV? Because depending on what the equity raise was, that's the amount of depreciation that can go around. The more equity that you raised, the less depreciation there is to go around. There's more people to split the same pie. And people are always very, very happy to be like, oh, I got 75% LTV, especially in today's market. I got 80% LTV if it's possible. And we all know that being over leveraged, I shouldn't say over leveraged, just because you got 80% LTV, that doesn't mean you're good to go. Sometimes it could actually backfire. If you could give us just like your take on the situation. Obviously, no two deals are equal. And in one deal, it could be good to be highly leveraged. One deal, it could be good to be not too highly leveraged. But when you deal with these situations, what's your initial take on it? What's your initial take on what's been going on the past few years of folks that have taken out a bridge? Those bridges are expiring. They are over leveraged. And now they're really, hey, they have to take out a stabilized loan at the traditional rate, and they really can't pay up.
I think it's a great question. There's a few angles to that. First of all, I think that anybody in the real estate industry knows that real estate owners are dreamers. They're taking something on that generally is extremely challenging. So they'll take on a project, even a construction project, going through the approval processes in the city can be tremendously difficult. So most real estate owners that I know, especially if they're raising money, they're trying to make as much money as they possibly can. So I think it really boils down to what your game plan is, what you're trying to accomplish in the market. Leverage can be an amazing thing because you have to raise less equity. You can get a bigger piece of the pie. Over time, you can make more money, especially if you're a younger guy. We have a lot of clients and I have a client that turned 25 3 weeks ago, and he owns over 4,000 units. So it really depends who you are in the market. We have clients that were under leveraged on buildings in Manhattan, gorgeous prime real estate in Manhattan, and they were under leveraged, and they have to come. We have a deal now. You have to come out of pocket $1 million because we were trying to rate lock 2 months ago. He was like, "Nah, I'm going to wait," and then interest rates jumped 80 basis points, and boom, So I think leverage is really something that, especially as a mortgage broker, it's super subjective. When I get on the phone with a client, my first question is, what's your game plan? What are you trying to do? Because just pushing an 80% loan to value because that sounds exciting isn't always the best. But then sometimes a guy who's only planning on taking 70 and really because he's trying to hit a certain IRR, he's trying to make a certain amount of money. He's younger. It's better for him to take a little bit more leverage and take less equity. I mean, when you think of it from the other side of it, if you weren't 80% leveraged and you were only 70% leveraged, then that means somebody lost 10% of their equity, right? So it's really not the simplest, it's not such an easy question to answer as far as what we're doing for our clients. And I find this, I hired somebody from Meridian who happens to be one of my childhood friends, one of my closest friends. He's a numbers guy. And he'll dig into every setup, every T12, and unless you're capable of doing that, which I'm sure these guys are, but a lot of the guys back in the day were just pushing paper. And if you're a paper pusher, you're never gonna get a loan done in this market because you have to make sure that every single dollar is accounted for, and you're able to show the strongest NOI that you possibly can. Sometimes we'll get a client come to us, and we tell them, "Hey, you got to come back in 3 months. You got to go, work on leasing because you're short 5% of your loan amount, and it's probably better for you to speak to your lender, get a little bit of an extension, and work the property a little bit more to get to your dollars." So it's definitely a challenging market. A lot of people are losing properties, unfortunately, but the properties that are able to be saved are really, it's a 3 to 5% difference a lot of the time on your income, and just figuring out how to get that number to make the deal work.
100%. And and especially I believe by younger guys that everything is about the return, the return, the return. The cash flow? How much are we getting back? How much can we give to our investors? We want to entice them. We're in a market that there's a dime a dozen when it comes to syndicators, and everybody's fighting over a lot of the same investors. And if you have higher leverage, you're going to be able to give initially better returns to your investors. So it's so enticing to do, but like you said, so many times it just doesn't make sense. I mean, it all boils down to your game plan and a realistic game plan, because if it's not realistic, you could be in a market that's going to take time for your property to produce, whether it's in a harder market, whether it's New York or blue states, where it's just, again, the leasing market. There's markets that people are heavily into, whether it's different places in Texas, but some of them have an overstock of apartments, and people are suffering on the leasing side of things. So who says your properties are going to produce? Very nice you have your game plan, but it doesn't always come out that way. Israel, what's your take?
Yeah, no, I agree very much with what Jake was saying. And it's interesting because a lot of times I'll introduce myself to maybe a new potential client and they'll ask me, where's the market at? And in terms of leverage, in terms of spread, rate, especially on today ground up construction, and you're trying to give a lay of the land in terms of where we're shaking out on LTC, for example. And it'll be like, yeah, I mean, some markets we're closing in the mid 70s, all in LTC, and other ones we're going to be stipped at 65% LTC. And I think more than a function of leverage, like Jake was saying, it's about understanding, number one, the investment game plan of what you want to accomplish, but also just the economics of the deal, right? You're not going to penalize a borrower that if your stabilized debt yield or this deal delivers and the numbers upon when the guy's going to stabilize look really strong. And I'm sure we'll find a lender at that higher leverage point, and the borrower should be more comfortable going in at that higher leverage point. That being said, I think one thing I do want to, say is that something that makes me feel good and comforts me is that I do work with a lot of younger borrowers. I work with some older borrowers, borrowers with some more experience, but I'm definitely seeing a change. So I'm seeing the younger borrower who may have been either almost burnt or is struggling on a specific deal. He's coming in with more, a little bit more conservative. He's asking me, hey, if we go 65% and we're in a tier 3 position, where does that put my spread? Maybe I could get some more IO, which, maybe if you dig into it from a cash on cash perspective, you could be, you could kind of get to a similar place. And ultimately, when your loan is coming to maturity, you'll be from a leverage standpoint, you'll be a lot healthier. And another point I'd say on what Jake is saying, there's different ways to structure leverage. We can blend something behind the senior, whether it's mezz or pref, and kind of split that current versus accrued and keep that constant, a little bit lower, which can help you achieve the business plan. But in general, definitely seeing a change, which is so healthy and which is kind of what the industry and the markets needed. So that's exciting.
I like it. Ricky, what are your thoughts?
I like that everything that Israel and Jake said. I think the only points that I'd like to add are, I think the leverage depends on who your audience is when you're asking the question. So, sometimes people want a better cash on cash return. So naturally leverage is going to be lower. And in some cases with syndicators, what I've seen is they don't always want higher leverage, even if that means giving up equity, because a lot of their limited partners and other investors are saying, where are we? What happens if we're going to lose tenants? Do we have enough breathing room? Yes, we would like more cash back if it's a refi cash out. However, not to the tune where we'd have to have an injection again. So I think it's not just the young syndicators and investors; it's also the LPs that don't want to be put in a position of being over leveraged. So my take here is I'm hearing different things from different groups, and going back to Jake's point, it's a function of what the goal is, and I think actually Israel said the same thing, and understanding everybody's different take within that transaction, inclusive of the lender's take. So kind of all over the place.
Got it. And it's interesting. The thought that just came to mind right now is that the two worst words you want to hear, I believe, in real estate is a capital call, right? Everybody hates that. That means something's wrong. And what's interesting is that initially, if you raise that amount of equity that you truly needed for that deal, for that game plan, it's easy to say you wouldn't have needed that capital call, but ultimately it could be the same amount of equity that you raised between that capital call and the initial equity versus if you would have just raised that amount in total and taken, I guess, lower leverage. If it made sense for that specific deal, you don't look like the bad guy. You're just trying to look like the winner up front. But sometimes, again, the young guys want to, and including myself, we want to be rich tomorrow. There's no long-term play over here, but I think that's important. Okay, we don't have an unlimited amount of time, and believe it or not, we're already almost a half hour in. So I want to jump to a conversation that we've talked about in previous episodes, but I believe that because it's the first episode with Debt Brokers on, it's an important conversation. You guys probably don't like it because you guys want to win a deal, but assumable debt. So assumable debt, from my understanding, is you're taking over the loan. To me, and again, I'm not a debt broker, but to me, it sounds like a no-brainer. Now, I do understand that generally deals with assumable debt sell for a premium. There are caveats, there are downsides, and I want to talk about that for a little bit. Rickey, can you start us off? What's your take on the assumable debt market?
It's a function of where that debt sits today in comparison to when it was taken out in comparison to the actual purchase price. A lot of times we'll see a deal with, I'm making up an example, say there's the amortization is 22 years. So, they're going to have to layer in either some mezz to make it work or bring in a lot of cash. That low 3% assumable rate or 3.5%, whatever that number is very attractive. But when you actually get to the economics of the deal, it's not going to necessarily work as is. So we see it, we'll transact on it, but it can come with some caveats where you have to bring in additional equity to make the deal work.
100%. But even if you do have to bring in that additional equity, many times I believe, and from what I've seen, it does pay off. If you're going to be able to lock in a deal at half the interest rate of what you're going to pay today, and assuming that it's not expiring in a year. It's like you sign a big guy to a deal and he becomes a free agent the next year, and then Soto goes to the Mets. You didn't get too much time out of him. But if you have, it's a 12-year loan and you have 7 years left on it, does it become a no-brainer? If you could get it at a decent basis.
Yeah, and it also depends on who you are as a sponsor and what kind of equity group you have behind you. Not every buyer is able to make a deal like that work. I'd say the more seasoned sponsors are more likely to pull something like that off.
I have a client of mine in Texas. He does 3-4 deals a year, all $20 million deals, and he's only been in buying assumable debt, like nothing else. He won't look at something that he's like a hardcore believer these days, and he makes it work. Obviously, not every deal is going to pencil out, but obviously,
I'll jump in
Israel,
on that, Isaac. I think it's very similar to Rickey said. It depends on the deal. The downsides of assuming debt is, number one, like you said, it could be a punitive exit. It really depends on what the terms that are coming in with, right? A lot of times you can have expiring IO, your rate looks good, but the IO could be you coming down. You're also tied to the metrics of the deal. For example, on agency, if you're gonna ever want to go back in for a supplemental, you'll be tied to his DSCR and LTV constraint that he originally took his loan at. So even though that kind of goes away, they're not going to downsize your loan on an assumption. It could affect you on taking that supplemental down the road. And then in general, I believe there's other dynamics to it in terms of taking mezz. You're tied somewhat to the original loan docs because it's kind of been sold. It's been pooled already. So there's a lot of different kind of points to it that I think you have to look at it in a big picture. So what I did see from a lot of investment sales guys was that they were like starting to market the assumable debt as like, oh, typically this deal would be worth a 6 cap. We'd sell it at a 6, but hey, we're going to sell for a 5 cap. And in the big picture, it's like, hey, what's the value of what's the value of the bones here? Like, we shouldn't be changing the basis of a deal on the means of assumable debt, because then we're kind of back to 2021 when people were buying deals at cap rates that we really shouldn't have been buying them at because debt was so low. So kind of have to put your hat on and really sit back and think about it. Hey, how does this deal look at a higher interest rate, and go from there.
I like it. Jake, what do you have to say?
I think these guys covered it all.
Listen, obviously, when it comes to the debt conversation, every single scenario is different. It's so hard to talk about it in a broad picture because there's so many nuances that could change. Just a little bit could change the whole picture. Let me ask you something, Jake. Preferred equity. I see a lot of guys, they'll talk about equity and it's harder to get LPs and they're more open to the preferred equity option. The way I look at it, and again, granted, I'm not a debt broker, I'm not seasoned like you guys, I'm a cost seg guy, but it's obviously a different position than a traditional LP, but it's not senior debt. It's not, you're not taking out a regular loan. You're just paying them out first. Is there any downsides to it?
Or from a lender perspective or from a borrower's perspective?
Both. Is it going to hurt the deal at all? Is there a chance that it's going to hurt the deal?
I know some really amazing owners that have been taking out preferred equity recently. I mean, there's a business to it. It goes back to what we were talking about leverage, definitely to an extent. Like how much risk do you want to be taking on? I think the reason why now there's a market for it more than there was before is A, like you said, a lot fewer investors are actually in the market, and B, that a lot of these deals they're not hitting leverage points.
So they're just really bridging the gap. But what would be the problem? I look at it as a glorified LP, where yes, you're paying them out first.
You're 100% right. You're 100% right. It's definitely it's a great business model.
I've had folks that I've said, hey, they're like, hey, Isaac, you know anybody who want to invest in this deal? And I said, hey, I have this and this guy, but why don't you speak to this guy? He does some preferred. I don't do preferred equity. And again, I don't know the market as a debt broker to know, hey, what are the real problems with it? And it could be there isn't any issues. It could be there isn't.
They can technically put you into foreclosure to an extent, or they can take over. They can take over your equity shares, which is a big problem. It's not as simple as just having an equity investor. A lot of people just want the simplicity of having an equity investor behind you. One of my biggest clients for years has been structuring, and I'm actually invested in them. They've been structuring their deals where instead of taking actual equity out, let's say they're doing a $40 million purchase, they'll take $10 million of quote unquote, they call it equity, but it's really debt. And the agreement is that they're paying an 8% return or 8 to 10% return, but the money's, it accrues, and they do a massive value add, and they have X amount of time to repay them with a refi, or it turns into equity shares. And they grew their portfolio. They were doing single family homes. They have thousands and thousands of units right now where they executed on that. But there's also the downside where they have that gun to their head where they have to execute at a certain point. And I know they've been able to execute, but they've definitely lost sleep at night because of that. So I think as it is, your rate is pretty high in today's market. And then to dump, more debt on top of that with a higher rate could be somewhat risky. But again, it's really it depends on your appetite. It's a great business model if that's what you're looking for.
Got it. Israel, what's your history with preferred equity? Obviously, you've had clients that have taken preferred equity.
Yeah.
What's your take on that?
Sure. Number one, the lender's got to be okay with it, right? So not every deal can work. The just intercreditory's got to make sense. You have to have a sophisticated attorney. I'd say you got to be represented by the right folks. That's first thing to know. Also, like Jake was saying, it's a great solution. You want to make sure you're not only are you represented well, but you're also a sophisticated enough borrower. It's similar to a lender in a way. So if you're not as comfortable in terms of leverage, I'm going up to a certain point because that's how helps you sleep at night. I think it's also important to know that that pref equity is real. It's gotta be something that you take into account when putting together your business plan for that investment. And they're gonna want to know for real how the investment is doing on a day-to-day basis and how it's cash flowing. And they're gonna want answers. You have to be ready to provide that. So, but I do think
I want to chime in for a second.
Yeah.
I want to chime in, and I want you to continue your thought afterwards. But basically, what I'm hearing is, and I'm just gonna play it this way for a second. I'm an LP in deals, and it's so easy for the syndicator and my syndicators haven't done that, but it's so easy for them to just write an email, sorry, the property is whatever, do all their fluff and everything, but it's not producing, and we don't have to answer up to you. They're going to lose out because on the next deal, you're not going to invest with them, but that's really all what it is. You can't do anything to them, right? If my deal is just, you're invested on this deal, the deal is not going as planned, we thought we were going to be 90% leased by November, and we're only 70% leased, they don't really have to answer up to you, except for the fact if they meet you at a sports game and you scream at them. As opposed to what Jake said, and really what you're saying as well, Israel, is that these preferred equity guys have really lender status in a sense where they could actually cause you real time issues. And what I'm trying to bring out is like almost like the LPs are like thrown into some sort of like, okay, I don't got to deal with you. I have your money. You made the deal happen. If not for you, I couldn't have done it. But I really don't have any liability except for the fact that you probably will not invest with me in the next deal. I just think it's interesting almost. You're saying, hey, these preferred equity guys, you're playing hardball with the real boys. You got to make sure your deal performs, and you have to make sure you have answers for them. I believe, and this is just, I guess, more of a moral stance, that LPs are not going to have as much leverage, but it's funny the way we look at it. Okay, LPs, we'll send out an email and tell you, sorry, occupancy is down. Hope to have better news for you in 3 months. Just an interesting point.
But Isaac,
LPs have very little recourse. Yeah.
No.
All right.
No,
exactly.
but I think more than recourse, and of course, I think every investor owes it to his LPs to be completely transparent, obviously. And besides, for future deals, it's their money is that you're working with. But in general, I think just to clarify a little bit, what I was saying is, if you want to make a management change, third party management change, and you feel like it's right for the property, an LP won't have a say, not because they don't have a say, because it's kind of like that confidence that the LP puts in the GP to the managing member to get how to operate and execute the business plan. Pref equity, provider can have a very different idea than what the borrower wants, and they can be from out of market, but they can have the voting rights and tell you and put a stop to that. So it's more constrictive, I would say, to clarify what I was saying before, than telling you what to do and being prepared. You should always be obviously ready to answer any question and be transparent.
Right. Understood. And I wasn't going after you in terms of, oh, you're saying the LPs don't have any say.
Right.
I'm just saying in general, the way the world looks at it is like, oh, preferred equity, I'm going to have to answer up. Lenders, I'm going to have to answer up. LPs, I'll send an email out and hopefully down the road it'll be better. Why wouldn't lenders want preferred equity?
Honestly, it's another layer of exposure between the borrower and them. It's another party to deal with. And again, there's a lot of working together that has to be done, right? Most lenders are going to want to see a blended cash flow, and it's going to be another strain on the borrower for getting potentially, obviously the senior lender will be holding the first lien on the property, but I think it's just another party that gets between them and the borrower, which is the last thing, maybe a lender would want.
Got it. Rickey, any take on the preferred equity market?
I want to echo Israel's point on having the right legal team and any other external advisors to get an objective opinion on the matter. And I like the point about the intercreditor agreement. That was spot on. The last point is really a function of reputational risk. So yes, they could just send out an email and say, hey, here's what we decided to do. And I'm sure a lot of people do that. But as long as they say, hey, we've weighed out all the different options that are available, we could have an equity raise again or capital call, whatever, and we chose this because of this reason, that's different than just stating it. So it's not necessarily the message that they're delivering, it's how they deliver the message, which would then hopefully gain respect from their investors to invest in future deals and explain the whys behind it, even if it's obvious.
Understood. I like it. Wow. I'm learning here myself. Maybe I'll become a debt broker tomorrow. Rickey, let me ask you something. Any deals that you would stay away from? Obviously, we're talking about if you have a guy that calls you up and he's a bad rep, of course you're not going to deal with him. Just it's not worth it a lot of times. In terms of actually deals, asset classes, types of deals, I'm assuming it's happened. Fill us in.
Yeah, so when people ask our company, hey, what are you not doing? I would say anybody with bad character in general. Like if we look them up and they have fraud or anything of that nature, we really don't want to represent people that have some kind of public issue or upcoming issue. I think that's really the biggest thing for us. Normally a lot of lenders or brokers will say, yeah, we're not touching office, we're not touching hospitality. We've learned to reserve judgment. In 2023, we actually did the most office transactions ever. I mean, probably more than 22 and 21 combined. And so what we learned was to understand the sponsor's entire portfolio and say, okay, if we can only get leverage of, say, 40%, can we put additional leverage somewhere else? Can we play around different assets? Can we bring in investors? All different types of scenarios. So we've learned to just not just listen to the story and what they're requesting, but see some preliminary documentation to see what avenues are there. And then in our world, the most appropriate thing is to present as many options as possible and say, here's what you can do. If you're not quite there, let's talk to your advisors and see how to get there. But outside of character problems, I don't know if there's anything specific we're staying away from. I think there's generally an appetite for just about everything that's reasonable.
Right, right. Understood.
I think that in today, what Ricky's saying is especially coming out a lot in today's market, because with all the news and all the people that were not good characters, and it's like basically most of them have been weaned out. Like, we're finding the one or two that are still left, it's very, very easy to tell who they are. They talk differently. They're not realistic in the market. You'll pick up on a lie that they're saying. Lenders are so wary of it right now that it could, even if you're really trying to get a deal done, if he's not a good guy, first of all, your deal is not going to get done. And the lenders are going to really look again at anything else that you send them, because just because of what's been going on in the marketplace.
Got it. Are there any deals that you would stay away from? Asset classes, types of deals?
I happen to think construction is actually a great market to be in right now. So as far as I would, if I was a client and had the ability to choose, I would actually choose to do construction right now. As far as deals to stay away from, as a broker or as an owner?
As a broker.
As a broker, I mean, you really have to make sure that whatever you're working on is going to work, because, and even if the guy has to come in with money, a lot of people are willing and able to come in with cash, but you need to have that conversation right away. If you don't, you could spin your wheels like crazy, and you totally completely wasted your time. Collections have been a big problem over the past year. It's really, really important to make sure that when you're underwriting a deal, you find out what's going on at the property as far as collections. And that's across all asset classes. Like Ricky was saying, you can get an office building deal done. The leverage is not going to be great, but you can get it done. But it's really just important to understand the deal. Like, very, very important to understand the deal. The client, how much money they actually have available to them.
Right.
I'd say that's the biggest driver in today's market.
It's really amazing, because when it comes to other services and even high ticket services, it could be investment sales, where we're talking about you're brokering a big property, but the process is very, very, very similar a lot of times. When it comes to debt, obviously there's a certain process that you're following, but like every single deal is from what I understand is just so different. Aside from different asset classes, obviously hospitality deal will be different than a multifamily deal, but in terms of what the game plan is and how long they want to hold and what type of debt they want, it's literally like it's miles apart. It's
how many people have tried coming into the debt space and automated it and created some sort of like AI system and thought that they were going to kill it? You can probably do it in the residential space, but in the commercial space, I've never seen a deal that was even the simple, a 10-unit multifamily that we thought would go to a local bank, and all of a sudden there's a permitting issue, or there was a slip and fall at the property and there's a lawsuit that you had no idea about, and somebody needs to come up with a solution for that. And your AI robot is going to Google it and come up with something that's just not going to work. And it's funny because until the past, I would say 2-3 years, there was a certain level of automation where you just go to, let's say, New York Community Bank, or you go to customer, whichever bank it was, and it was fairly simple, and you could probably automate that. But where we are in today's market, it's just not. It's not there.
It's true. It's true. Wow, Israel, I see you smiling. I see you like this conversation.
Yeah, I would say that more than to go back to your question about like which asset class, I think it's more of setting the right expectations to the borrower. Like now more than ever, like we're all in the business of making loans and getting, working well with our clients, and you never know which asset will bring, the big deal down the road, and you never know what will cultivate the relationship. But more than ever, today's market, borrower comes to you with a deal, tell them, just be honest where you think you're going to get to. I think the borrowers want that today more than ever. People are more realistic, I think. Maybe not every day, but sometimes. And just be straight up. Even if it's a difficult office deal, it's 100% occupied. And still, I still don't think you're going to get below 6%, So I think that's what it comes down to. Just be upfront.
So as we near the end of the show, this has been an awesome conversation. Ricky, let's start with you. Like we said in the beginning of the show, Crux Commercial Partners, love what you guys do. I love your vibes. I follow you, obviously, and Jacob, and you guys have your parties and you guys have your events. What makes Crux Commercial Partners different? What makes you different? And what's a piece of advice you'd give to a new investor and a new debt broker? We all know that there's a million debt brokers out there. So it's a flooded space. There's a lot of owners. So there's a lot of people to deal with. What piece of advice would you give? Take it.
Okay, I think I can memorize these three questions, but correct me if I don't. I would say for a newer investor, I would highly recommend documentation and communication. Some of the easiest things that you can control is being responsive and being organized as a borrower, presenting what the lender is asking for, or in our case, what we are asking for, with hopefully little pushback. If you're going to hire a professional, please trust them that what they're requesting is going to be necessary to get your transaction completed. So that would be for the borrower. For a debt broker, for some of our guys and gals, one of the things that I like to tell them is don't just go looking for clients from the get-go. Try to understand the different lending platforms that are out there. Try to make sure that you build relationships, because as much as the deal can stand on its own and the sponsor can stand on its own, there is an art to the transaction. Lenders you will build mutual trust together. You want to understand what their hot buttons are. Everything in addition to the policies, like how long does it take for the transaction to go through? Are they full on multifamily? Do they like owner user deals, and so on and so forth? Because you could be great at obtaining a potential new relationship, but if you don't know where to take it and you don't know how long it's going to take and you can't set the right expectations, then it doesn't matter. So really knowing those platforms as best as you can. What makes Crux different? Several things. A lot of us were lenders, and in my specific case, 20 plus years. We have hired seasoned people that have been successful within their roles. That's number one. Number two is we feel we present organized packages that are pre-underwritten by ex-credit analysts and credit officers that we took on from institutions. So we do our best to present something that is the need to know, not fluff. Say it how it is. Be open and honest with your lenders. We don't like to shotgun our deals all over the place for many reasons. One, because of privacy reasons, and two, we feel we narrow down who the primary targets are that would be a great fit for that relationship. So organization, setting expectations, and presentation. That's
Love it. I love it. Beautiful. Jake, what makes Fortune Capital Group different? What advice would you give to a new investor and a new debt broker?
First of all, Ricky, that was great. I think that's what you need to be as the epitome of a mortgage broker. So that was very well said. What makes Fortune Capital different? I think, again, in this market, it's really just about understanding the deal and having the patience to look through every single number on the T12, to look through, just understanding everybody's business plan. That's something we're extremely relationship oriented, and we're not paper pushers. I won't take on a deal that I don't feel like I don't need to be exclusive. I don't need to be the only one that he's talking to, but I need to have control over the guy. I need him to be talking to us and explaining to us every single thing that's going on in his business. I need to understand what was going on in his past. I'll ask him questions about his family just to understand what his mindset is. And we really spend a ton of time trying to get to know our clients. I went to Devil's Game with a couple of clients of ours on Sunday night just because I hadn't seen them in a couple of months. And we had done a bunch of business. We're still doing a lot of business, but 2025 is coming up. We needed to know, what's your game plan? Which lenders are we going to make sure we're going to be targeting this coming year? So I would say that's really, as a fairly boutique shop, that's a huge value we bring to the table. My underwriter, Mike Helmreich, worked for Meridian for a really long time. He has very strong, I think Israel knows him pretty well, very strong lending relationships. He really, really knows what he's doing. So I would like to say that, just being a great representative for our clients is probably our strongest suit. As far as what I would say to new investors in the market is just be realistic about where today's rates are. Find deals that work with today's rates. Do not go into a deal expecting that rates are going to drop. Nobody knows where the market's going. Geopolitically, there's just too much going on to think that you're going to be able to buy a deal at one number and refinance at even at a 4.5% rate. I think there's too many unknowns. Investors are putting money out with guys that they trust. If you show up with a a real deal, can show a track record that you have a reason to believe you're going to be able to operate this property well. Again, collections is a problem, so you have to make sure that you're able to hit your collections. There's a huge value right now. There are people that are doing marketing for leasing that makes your property look well. Like, make sure you have a really, really good team behind you, and don't just buy a building that you're hoping you're going to do well with. I think that's the number one thing that I would say. And then as far as new brokers, I think this is the golden age of finding new clients. So many brokers that I know built a business in 2008 and they didn't do any deals for 3 years. It sucked. But then in 2011, 2012, the guys that were not good at what they did were gone, and they were there to pick up all the business. So be very, very patient. This business sucks a lot of the time, especially in today's market. I'm sure Rickey and Israel can speak to how many deals they've been working on that the guy can't move ahead, rates are too high, the deals don't pencil. Just be patient, keep talking to people. People need brokers right now more than they ever did. I know you said the market's saturated. It's not close to as saturated as it used to be. We're noticing that most of our clients most of the people, even people I've been chasing for years, are picking up the phone. They need somebody. They need a guy that knows what he's doing. And guys like myself, Rickey, Israel, that have been doing this for a while, that are not just paper pushers. It's a great market for us. And if you're a broker that's willing to hustle and wait it out and be patient, you'll do very well.
Love that. Wow. A lot of great points, Jake. Thank you. Israel, last but not least, give us some insight. What makes you different? What makes Walker different? Some advice you'd give to a new debt broker and owner.
I'll start with the new owner. I think, again, it's an incredible time to be on the market. Again, you got to be careful. You're looking at, there's deals that are out there. Not everything pencils. I feel like we're kind of at like that cusp of things starting to make sense. But again, it comes down to saturation in terms of everything, in terms of the mortgage brokerage industry, in terms of, the syndicator or the prospective buyer. And I think that's dried up very much. We've weeded out a lot of those buyers that maybe, extended themselves too much or maybe have to move on now. I don't see the, bloodshed as people were saying. I'm more of a positive kind of guy, and I'm definitely not seeing that. But I do think that people are going to be pushed coming into 2025 to make hard decisions, which means new opportunities for a new cycle, which leads into my next point. To a guy, looking at what job he wants to, which direction he wants to take maybe within the real estate industry. I think it's just a great time. Isaac, we were at a conference together recently. I think I made the comment to you. I'm like, it's crazy. There's just no young guys here. Maybe 2-3 years ago, it was bustling, just so much young energy. Again, we're young, but just really young, there isn't right now. So I think, to Jake's point, right, guys are answering the phone right now. People want to hear, creative solutions. So now is a great time to get into the industry, but don't just go and think that you're gonna, do 100 cold calls and hit. And you also want to know what you're talking about. You want to have the right solutions and be prepared when you're given that opportunity to make sure you can deliver. To the third point about, a little bit about Walker and Dunlop, what I think is unique about us is just our volume. The numbers we do annually, we're the number one Fannie Mae lender in the country. It's just the capabilities and what the trickle down effects from just doing so much business nationwide is incredible. I can have a client looking at a deal out in Dallas. I can instantly get, ping the investment sales guys and get true real life sales comps. We can reach out to our appraisal company that we work with and get you, your real estate taxes reassessment numbers. We can huddle up with our research team and build out, a lease up schedule on new permits that being pulled for a developer out in California. So I think that really lends itself to, excuse the pun, to just a full gamut, fully integrated solution, and something I've been enjoying very much here and love handing that off to the borrower.
Wow, I love it. Obviously, there's good things about a boutique shop, good things about a big shop, and I always tell everybody, and you guys know this yourself. There's an endless amount of owners. A lot of us are LinkedIn guys, and a lot of the LinkedIn owners, I guess, gather together, and it's like, oh, we all know the same guy. I go to a conference sometimes, and these guys are not on LinkedIn. I'm like, oh my God, like this guy owns a few thousand units. This guy, I never even heard of him. There's so many people out there. Obviously, transactions are down, but there's still a lot happening. Anyways, guys, thank you so much for coming on. This was awesome. Rickey, Israel, Jake, this was incredible. I really, really appreciate it. To the audience, you guys have a good listen over here. You can find Rickey, Israel, and Jake on LinkedIn. If you want their information, reach out to me. I'd be happy to give it to you, and you can chat with them. Thank you so much, guys. Signing off. Have a great day. Hey, everyone. Thank you so much for tuning in to the Stage Debate podcast. This was a fun one. Appreciate you guys tuning in. Definitely connect with me on LinkedIn, get a hold of me. Let's talk podcast, let's talk COSAG. Subscribe and get notified for all future episodes. Thank you and have a great day.